of tools. Some of them I think they're complex, but they don't have to be. So we can talk about making things a little more simplistic, because I'm of that mindset. Like we don't have to create this amazing, massive cash flow projection that looks great if we're not going to use it. So that's sort of the message, is that, hey, let's make things as simple as possible. Let's make sure that make it as usable as possible, and then obviously follow up and use it from that standpoint. I'm going to do just a quick little intro into kind of Small Business Week. I know that you guys are aware of Small Business Week, but basically, I just wanted to talk a little bit about sort of its origins, and then this year's sort of theme, I guess, is what we call it. And I think for Greg, you probably heard this yesterday, largely, and anybody who joined yesterday would have heard this, but I just want to go through it really quickly. But ever since 1979, BDC has dedicated 1 week to celebrating Canadian entrepreneurs. It's a celebration that consistently revolves around ingenuity and determination, which is what sort of everyone on the call here has. And what better year to continue the tradition and sort of not lose that continuity, even though we're going through a tougher time than sort of normal. This may be our 41st BDC Small Business Week, but in many ways, it's also a first because we're holding it virtually, like today. It's the first time we're having it during a pandemic. And even though we've seen economic downturns since that sort of origins of 1979, we've never seen one sort of quite like this, with so much complexity and uncertainty. There's a lot of new realities this year, but there's one thing that hasn't changed. Canadian entrepreneurs are still impressing us with their ingenuity and determination. As you can imagine, BDC, we've spoken to many entrepreneurs since the pandemic started in March, and even though the past months have been some of the most difficult that you guys have faced in recent history, you have risen to the challenge repeatedly. And I'm going to stop kind of on that note and just mention that when this whole pandemic started, whether it was clients of the bank or new prospects or people that we had sort of met in the past that had reached out, the sentiment was the same, in that BDC as a bank, we reacted quickly. But the biggest thing was we were a little bit of a sounding board. We were able to really have those conversations and try to navigate with sort of our clients and new prospects to the bank and whatnot. This year's theme for Small Business Week is Forging the Way Forward, which is timely. We're taking a week to recognize your incredible capacity for innovation and resilience, and will also help you understand how the business environment has changed and what you can do to build into the future. And I think that's what a lot of people here are here for too. I want to share just quickly 5 key priorities for the future that entrepreneurs have on their radars. And these are from, BDC did a recent study, and basically that study is available. I can make that available to you guys, or it is on our website. But a lot of times what we do is we will query entrepreneurs across Canada, whether they're clients or not, to try to see what the sentiment's like across the board. So of these 5 things, first, entrepreneurs are putting their finances in order by rebalancing their cash inflows and outflows, which is timely and of topic today. Second, entrepreneurs are taking advantage of technology to improve efficiency, reduce costs, and stay competitive. I think the thing you hear about a lot of time right now is people going online. So if we sort of boil it down to things like product-based businesses, largely this was kind of the push that really sent them to go online and start that online presence, which is the 4th thing, selling online. Canadian consumers are buying online more than ever, and this really isn't going to change. And finally, entrepreneurs are actively working on reviving growth. So they're not trying to stay in the status quo. They're trying to move that needle forward. Many are re-examining their markets, their customer needs, their distribution channels, and other areas they need to address differently than they did before the pandemic. and making those changes on the fly. So as Canada's Bank for Entrepreneurs, we'll continue to be here for you. Since the start of the pandemic, we've participated in government relief programs, provided support to countless SMEs. We'll continue to offer financing and advice to help entrepreneurs achieve these 5 priorities, steer through the second wave, and help plan the recovery from there. So that, I just wanted to give kind of a little bit of context. And I think Tanya and the Clarington Board of Trade did a really good job this year of putting together kind of 4 events that are very topical, and 4 areas that can really help entrepreneurs kind of weather this storm. We will get out of it. It's not, I don't think it's doom and gloom from that standpoint. There will be some businesses, unfortunately, that may not have planned as well for it. But for the most part, what we're seeing from our client base is our portfolio is healthy. Our businesses are making the right choices, and they're growing out of it. So what I'll do, I'm going to launch into the presentation really quick. And like Tanya said, definitely throw things into the chat box if you have a question, and then Tanya, just interrupt me as I go through. I'm kind of working off of 2 or 3 screens here, so it's hard to find present while having a look at that chat box. So if everybody's okay with it, I'm going to jump right into the presentation, and yeah, we'll go from there. So let me do this. Share screen. Okay. Tanya, can you see the presentation? Just give me a thumbs up if you're good. Perfect. Okay. So today, obviously, the topic is mastering your cash flow. Kind of broke it down into 3 steps, and we'll kind of go through it. There's some in-depth things and calculations within here, and what I can do after the fact is if it relates to your specific business, I can absolutely provide you with those kind of detailed calculations. And some of them are found in some of the tools that we do have on bdc.ca. So they'll auto calculate for you. It's just a case of taking your data and inputting it there. But what I'll do is like I said, we'll go through them in depth. If there's more clarity that's required, feel free to throw it in the chat box, or again, we can go through it on a one-on-one basis. That's the nice thing about these events, because given that they're a little bit smaller, we can kind of have that interaction from there. So we'll get started. So just a quick plug to start off with for BDC. So this was kind of our older tagline. BDC is the only bank exclusively devoted to entrepreneurs. And we've simplified that as of lately, and it's just now we are the bank of entrepreneurs. So the whole idea is that we are a Canadian bank. We act as a like a complementary lender to your chartered bank, so your TDs, your RBCs, etc. And we just do term finance. So we don't offer credit cards, lines of credit, bank accounts. They definitely take care of that. We come in as sort of a term lender from there. We do offer more than just financing. So we're one of the only banks in Canada that actually offers advisory services also, meaning ultimately consulting. And basically we consult around key areas of focus. Cash flow is one of them, or financial management is one of them. But there's a few other areas like operational efficiencies, management training, things like that also. And then obviously we offer financing. And then we play in the venture capital space within Canada on a few different levels, but not many people know we're one of the largest venture capital players in Canada, which is kind of cool. So where are we? We serve as ultimately 49,000 entrepreneurs and growing. We have 118 business centers across Canada, and you can kind of see those business centers dotted in dark blue dots there on the map. And then we have roughly 2,200 employees. That number obviously fluctuates up and down, but there's bigger focus, definitely in kind of rural areas with larger teams from that standpoint. But like you can see, there's definitely business centers up north, and some of them are accessible via planes. That's our mode of transportation up there. So getting into it, ultimately, we're talking about cash flow today. So ultimately managing your cash is one of the most important jobs that you'll do as an entrepreneur. It's similar to what you do at home, right? As it relates to budgets and whatnot. You definitely want to keep an eye on things. So even when we talk about like profitable, fast-growing companies, they can go out of business too if they don't watch their cash flow or they run into a serious crunch. But interestingly, like through my conversations, or even the conversations we have with entrepreneurs through our studies and whatnot, they're just simply not managing their cash flow and watching it. So some of those topics that we end up doing surveys on, for example, like we had results where we looked at it, and almost half of the entrepreneurs surveyed said they don't make cash flow projections, they don't watch their cash, and they don't compare it to actual results to see how they're sort of actually doing, which was sort of astounding. So basic financial housekeeping. One, we want to make sure that we're generating profits. We want to make financial projections, and obviously challenge those financial projections and make sure that we're on track, and be real with the numbers. And then from that standpoint, improve the company's cash flow at the end of the day. We want to avoid stumbling blocks and ultimately create a stronger business as a result. So make sure that you're generating profits. If you want to improve your company's cash flow, the first step is to make sure you're making money. If your business isn't profitable, better cash flow management, while a helpful item, will be no better. It'll just be a band-aid solution ultimately, and could cause some future issues down the road. So 4 common kind of pitfalls as it relates to like ensuring that you have profitability is, first, generating insufficient revenues. It may seem obvious, but the first question to ask is, are we actually bringing enough revenue in to cover our expenses? And having a good look at that. And if not, like, why are we not doing that? It's really important to quickly determine the specific reason and address it right off the bat. The second pitfall is inadequate pricing. So it's fairly common for small business to change prices that are too low to generate an adequate level of profit. But often the fear is that, hey, are we going to lose customers here? That isn't necessarily a bad thing. And it's not necessarily a bad thing for your prices to be higher than competitors. It's perfectly reasonable, in fact. And if your strategy is based off of differentiation, offering a unique or specialized product is a good thing, and at a fair market price also. The third sort of area of low profits is inefficiency. So we define that as waste of all kinds, and it can be lurking really in your operations. It can be pushing up your costs. It can be reducing your profit. It's things like it can be things as inefficient as I remember I was working for a company previously, and it was an IT company, and I walked into sort of our server room, and I looked up in the sky or in the ceiling, and there was like an internet cable looped up, and it had like a little code on it. So I picked the code, and then I went back to my billing person. I said, "Can you pull this PIC code?" And I went back to IT, and I said, "What's happening with this internet line?" "Oh, we don't use that anymore." "Well, how long has it not been in use for?" "Well, it hasn't been in use for 6 months, a year." "Okay, well, that would have been good to know." Went back to my person who was looking into the billing, pulled the bill for me, and we were locked into a 3-year contract at $10,000 a month. So this was a larger company, but you start adding up those wastes or inefficiencies, and quickly profitability is impacted. And then finally, the fourth sort of pitfall is poor product mix. Do you know the profit margin for each of your products or services? That's one of the keys. Analyzing each one separately can be an eye-opener and actually can reveal, issues and lack of profitability that might have been lurking. So have a look at those. The big one here is making financial projections. So once you've begun to look at those profit issues, waste, things of that nature, it's time to actually focus on cash flow management. And it starts with really that projection. So here's a question, and maybe Tanya, you can have a look and just chime in a little bit from the chat box. But today, how many of you are making financial projections or looking at that type of thing? And I'll give you a second just to jot it in there, and then maybe Tanya, you can tell me what the result is.
So Jillian says nope.
Okay.
Yep, we have a few. Candace is yes, she's doing it. Melanie, definitely, she's always plotting.
Good.
Mike is he does not, but his accounting department does.
Okay, good.
Greg is a yep. Candace, I try to anticipate what future expenses could be. That
Okay,
must have been very difficult in the pandemic.
Yes.
I think that's good for now.
Everyone, okay. So that's good. There's a good mix there. It's funny because making financial projections for me personally, and again, I'm going to relate this back to personal life. I'll say this: I'm a little bit over the top. Like, I project out what my expenses are going to be as it relates to the house and the kids and all that kind of stuff. And then I obviously link it back to what's the cash flow going to be, and let's make sure that we're on the positive side of things. But it's extremely important, and I know some of you mentioned obviously you're doing it, or your finance department is doing it, and that's good as long as there's sort of review happening, and it's a priority. Because it's interesting. I talked to a consultant some time ago that he worked for the bank, and we were very successful on sort of the financial management advisory solutions. And it's funny, he used to sit in on the first presentation. The first presentation, he would always talk about running a business, and he always said, if you can have one fundamental thing, it's financial management, period. Yes, you have to make sales, and yes, all these other things have to fall in the line, but ultimately, if you have the ability to manage finances, you can ultimately manage any business that there is. And this was coming from a person who owned marinas and restaurants and like hardware stores. Like he had a mix of different businesses that he bought and sold over the years. And he goes, the proof is there. And a lot of clients that we worked with obviously saw that after the fact, but the biggest one came back to us and said, you were right. I think he was a landscaping company, and he had actually purchased a marina thereafter, and he created like profit there and ended up selling it off at obviously a greater profit. So we'll talk a little bit about financial projections, and we'll talk a little bit more about cash flow now. So making financial projections. So plan your cash flow, and then obviously there's the planning phase, but then you actually have to track it thereafter. So topical, that allows you to plan ahead for times of lower cash flow or upcoming projects. You have more control, and that's good obviously for peace of mind. Planning won't get you far unless you track your actual results, though, to sort of what you're projecting. So let's take a little bit closer look at how to make those financial projections. So I'm going to break it down sort of into 7 steps. So first, plan your upcoming year. Think about what you want to accomplish over the next 12 months. This is based off of sort of your strategic plan for your business, and be sure to list anticipated big ticket projects. Like, for example, if you were, in the business and you were buying a new truck or redesigning your website or updating computer systems or something like that, make sure that those are there. Second, make the projections. So create a simple cash flow. Like I said before, let's make it simple. We want to be able to use it and use it easily in Excel or whatnot. Based on your experience and your plans for the coming year, make projections of expected cash inflows and outflows for at least sort of your next 13 weeks. Some people say, well, it's hard to go, 12 months out, but let's go 12 months out, but really let's focus on the next sort of 12 to 13 weeks. Again, major ticket purchases, cash inflows and outflows is what you're really keeping an eye on. The third one is focus on actual cash flow. Don't assume sales are going to convert to cash right away. Enter them as cash only when you expect to get paid based off of the experience. So if you know, for example, that you have somebody who's not going to pay you for 90 days, it doesn't go in the next 30, it goes in 90 days from now. And then fourth, do some contingency planning. And this is a good opportunity to consider what you'll do in the event of a sudden cash flow dip. And it's better to have kind of emergency plans ready to go than wing it in a crisis. Again, very topical for right now. And what we did see was customers that were planning for those like contingency items, largely they didn't have cash flow crunches, and they were sort of on the I'll say the proactive defense during COVID-19. So if they were a client and they were calling us, they weren't necessarily asking us for money. They were saying, hey, as part of our cash flow projections, can we defer principal payments? We'll continue to make interest payments, but can we defer principal payments? And we had no issue with that. And that helped their cash flow a little bit. And that's where they were able to kind of update their forecasts and say, okay, we have the ability to kind of weather this storm. Number 5, think strategically. So use your cash flow planner to experiment with different types of sort of what if scenarios. You can take a look at things like if you're collecting, like you have faster bill collections, slower bill collections, slower cash outflows, or improved profit margins. Kind of what does that look like within your cash model? 6, set a cash reserve. So many businesses like to have enough cash on hand to cover at least 90 days of operations, including cash in the bank and room on the line of credit. So we are talking about cash, and sort of cash is king, but again, your line of credit can be used as sort of a backstop from that standpoint. So we're always bumping up against the top end of our line of credit. That becomes an issue. We want to have some room on there. Finally, number 7, get help. So consider getting some outside help, whether it's, it can be BDC, it can be like a bookkeeping firm, it can be your accountant. Generally speaking, what I hear a lot is, well, we talk to our accountant, but they just do our year ends. They do a lot more than just year ends, and they do have the capacity, if we ask, to say, hey, this is what I want to do, and this is kind of the financial model I want to create. Can we work on this sort of together? And they definitely have the ability to do that. So tracking your progress. So 3 key metrics to monitor. I'm just going to kind of go through those. One is cash conversion. So how quickly can you convert that cash from sort of the sale into actual cash? Inventory turns. Now, just hearing the types of businesses that you guys are running, inventory turns may not be as applicable, just given the fact that in some cases it's very much like a service base. And like, I would give you an example. So obviously, like, well, real estate transactions, yeah, I mean, you can look at the houses that you're selling as your inventory and how quickly you can turn those around. So that would work. As it relates to insurance, that's obviously a lot of like cash conversion, sort of on the spot. So there's a service rendered and it's an ongoing payment. As it relates to like yoga and wellness, again, you might have like a membership base. So, if you collect a fee up front, and let's say classes run for, 6, 8 weeks, whatever it might be. Obviously, you got to make that cash flow last for that period of time until that next renewal date, and things like that. So we may not spend as much time on that, but we can talk about it. And then finally, cash that is sort of physically on hand that we want to keep an eye on.
Matt?
Yep.
I have a quick question for you, actually. So I'm looking at all these, these great suggestions. I'm going to say that you're having for businesses and everything, but for somebody like, say, Jillian, who is a smaller business, and obviously, she's not looking at maybe hiring a large accountant or somebody like that. Do you have like recommended apps or websites or checklists or things like that she can kind of keep on hand to go every like quarterly, I guess, or something like that, kind of go through and say, okay, you know what, yay, check, okay, I need to work on that?
Sure. So the one thing that I would say is that on I hate to only point back towards it, but like on the BDC website, so bdc.ca, there's a ton of tools available. And not only are they tools, but there's also sort of like tutorial notes available within those tools so that you're sort of using them correctly. And they're designed in a way that they're very simple. So what'll end up happening a lot of times, like I used to work out in, obviously we talked about Peterborough, but part of that territory was Cobourg in Northumberland County. And they have what's called community futures development corporations. And they largely deal with businesses, let's say from startup to roughly, we'll say $1 million to $2 million in sales. But really that small business segment is their focus. They would generally use the tools available on the website because they said, well, here's the thing, we can go through it, but also there's good tutorial notes on there to be able to actually use those sort of solo or independently. Again, some of those tools I would say could even be like simplified, so to speak. And that's the way that I like to do it, is keep it super simple and not try to complicate things. I'm trying to think of other business resources too. Like, there's lots of partners within the community too, and they may even be available like through CBOT, where for, very low fees and things like that, they're able to help out too on a truly like one-on-one basis. There's lots of people giving back time that way too. Does that make sense?
It totally does. And so maybe at the end or maybe afterwards, you can send me kind of a link to your website and maybe some of the things that you recommend for the smaller businesses. Perfect.
Yep. I got some direct links, so we can send those over, and then we can disperse that to the group. Absolutely.
Yeah, that's great.
Yep. All right. So we talked about cash conversion cycles. So these, again, this is very much formula based. What I usually say is within your forecast and your cash flow management tool, just to incorporate these. And again, like I mentioned to Tanya, within those templates that we have online, these calculations are built in. So it's just a case of pulling the specific data from your information and then plugging it in, and it'll spit out what the cash conversion cycle is, for example. So what is a cash conversion cycle? It's your average collection period. So how many days it takes for your customer to pay you, plus the days of inventory outstanding. So how long it takes on an average to sell your inventory. So obviously if it sits for longer, it's going to be a larger number. And then minus the average days payable. So how long it actually takes you to pay your bills. And what this really gives you is the amount of days that it takes for you to convert cash ultimately. When we talk about turning inventory, so it's really the number of times your business sells inventory per year. Obviously, the more you sell, the more times you turn inventory. Um, it's obviously better because you're converting more cash. And then this is interesting to watch because if you have really long, and we look at it as a bank, if you have really, really long inventory turns, that can be a indicator of stale inventory that's just sitting on the shelves and just not moving. So it might be time to have a look at the strategy around moving inventory that hasn't been moving, and kind of getting it out of your cash flow cycle and converting it to cash. And then cash on hand. So continuously monitor how much cash you have physically on hand and check it against the target that you set when you actually set those financial projections. Some businesses monitor this daily. Some monitor it weekly and monthly and quarterly. So it just really depends. What I would do is I would put in sort of my own experience here in that I worked for, it was an online trading company back in the last recession in 08. And I was lucky enough to work for the one of the owners who was also the CFO. And we watched our cash flow and our projections on a daily basis. I was head of global procurement. So what I would do ultimately is I would be responsible for like, how much money did you spend today? And that ranged from a pencil up to like data centers that we had in the US that were, you know, $90, $100, $150,000 a month. So it ranged, but we literally got down to the minutia of like, okay, how much office supplies do we buy today? And that was important, especially going through that recession. And I would be honest, I didn't see a whole lot of red ink during that recession. And it was largely because of the planning and the cash flow that we watched. That was obviously a larger company, but I guess the fundamental message that I'm trying to get across is you need to be able to throttle the amount of review that you're doing of your financials, because in really good times, yes, you might be able to do it on a quarterly or a monthly basis, but in times where there's market contractions and things like that, you should be really looking at it more intently during those periods of time. So 7 tips to ease sort of that cash crunch. 1, talk to your banker. The first thing to do is really to go see your banker. Your bankers don't want to see you go under and not be able to pay back a loan for obvious reasons. But you may be surprised at the flexibility that they can offer. And I think we saw that during this pandemic, where traditionally, for the time that I've been at the bank, we as BDC were the only ones doing, for example, principal postponements. But banks jumped on board very quickly to put in place deferrals and things like that during this time. So there was an extreme amount of flexibility that they offered for their clients. 2, sell off inventory and assets. So like I talked about before, walk through your office or your warehouse or the services that you provide and see what's collecting dust. Do you need to be selling it? Do you need to be getting rid of it? Or maybe it's a service that you're providing that really you're seeing no uptake on. So shifting that focus to something that is a little bit more profitable for you, and really go after that sort of sale. 3, work with your suppliers. So can you get extra time to pay bills? Could you offer sort of partial good faith payments? The big thing is that most suppliers would rather get paid down the line than not be paid at all. And your cash conversion cycle is it's helped immensely if you can kind of defer that payment. And it sounds bad, but they almost act as a little bit of like a working capital financer at that point in time. 4, reduce your employee hours. So I know we don't love the idea of that, but you can temporarily cut employee hours if business slows. it increases your odds of keeping everyone on staff instead of losing sort of valuable personnel down the road. We saw a lot of companies do that during this pandemic, is that they kind of throttled their workforce. They may have reduced, working hours. Like if you worked a traditional 40-hour week, they might have split it in half, but they were able to maintain that whole workforce, and people were still able to sort of collect a paycheck, and it helped the business out too at the same time. Renegotiate your lease. So ask your landlord to reduce your rent temporarily. We did see that during this time for some people. Some people came back and said, no, there was no reduction, even though programs were in place. But here again, many landlords, they prefer to see, they want to keep a tenant rather than run the risk of having empty space. And this is something that holds very true. Like when we look at financing sort of investment type properties, we want to see those leases in place, those long-term leases and things like that. And if you can offer sort of temporary support, and I'm being temporary, not 6 months at a time, but maybe a month here or there, it's sort of that landlord playing the longer game, we'll say. Offering special sales terms for immediate cash. So some people do this and some people don't, but basically, if you want to generate fast cash by offering specials to customers, so think of creative terms to get the customer's attention. For example, offer a generous discount on purchases, and in exchange, ask for part of the bill to be paid sort of upfront. I've seen it where people have offered sort of price discounts and things like that, payment discounts from a quicker payment standpoint. So if you have net terms, for example, with a supplier, in some cases, what they've said is, well, you get a 5% discount if you pay within, instead of 60 days, you pay 30 days, you get a 5% discount. But this can have big effect on profitability. And then one to consider, but again, takes a little bit of time, is factoring. Consider selling your accounts receivable to a factoring term. I don't think in this group as we're talking about it, this applies, but this also is an option. Improving your company's improving your company's cash flow. So after ensuring the profitability of your business, let's look at 4 things you can do to improve your actual cash flow inwards. So finance smarter. So protect your cash flow, matching sort of financing to the asset's lifespan. So this is important. Like, for example, if you were to buy a truck, for example, you're not going to finance it over a 20-year term. You're going to finance it over lifespan. You don't want to be paying for that debt after sort of the useful life of that item is gone. So when purchasing long-term assets, the rule of thumb is to match financing to the asset's expected lifespan. And for most businesses, you can get flexibility you need for your various spending requirements with a mix of term loans and lines of credit and things like that. 2, get paid faster. So we want to get invoices out quick. We don't want to sit on them for a long period of time. We kind of talked about this a little bit before, but offering discounts to faster payers. So if you have net terms, you may want to offer a discount if they're willing to pay quicker. Doesn't really work as much from the standpoint of like a service-based business, for example, or if you have pricing stipulations in place that can't be changed. But it is an option. Getting tough on deadbeats. It's always an interesting one, but one for entrepreneurs say waiting for late paying customers is the worst part of being a business owner, because you're just constantly looking for it. The same proportion of entrepreneurs say they spend 3 to 5 hours a week invoicing and chasing overdue payments, and that's just, quite frankly, a waste of time. Although we want to get paid, it just consumes your time. So if you can sort of fire those people or get rid of the quote unquote deadbeats, your time's better spent elsewhere. And then consider firing laggards. So think about dumping the worst customers. And I kind of alluded to that just a second ago, but chronic late payers that complain excessively or they return like a lot of merchandise and things like that, it might be time to get tough on them and say, sorry, but it's a drain on the business and we won't be moving forward from here. with the relationship. And then 3, control cash outflows. So manage variable costs, focus on fixed costs and offer to pay more, invest in technology and give incentives to staff. I'm going to just talk a little bit about giving incentives to staff. So make people accountable for the costs in their areas of responsibility and establish appropriate rewards for employees who find ways to reduce expenses. One of the things that working for a larger company previously, our CFO at the time mentioned to me, he said, look, always treat sort of the purchases as if they're your own. So don't, because you think that there's an endless supply of money, just make a purchase just for the sake of purchasing it, but always question it and say, you know, do we really need this? Is this something that we have to do at this point in time, or can we defer it? Things like that. So this is where giving incentives to staff makes it makes a big impact. And then if you're in a business where you can employ them sort of they might be, for example, let's say they're a yoga teacher and they're working for you, and you say, hey, why don't we try to ramp up sales? So any net new clients that you bring in, you know, I'll give you, 10% of whatever the profitability is, or 10% of the sales. Giving those incentives to bring new customers in is a big draw for them too, because it pays them, and like we talked about, cash is king. 4, and this is the last one. So take control of your inventory. So we want to coordinate different types of inventory if you have an inventory-based business. Plan for changes in demand and volatility. So if your company has seasonal highs and lows in demand, you should modulate inventory levels to meet your demand cycle. Similarly, if you relate that back to cash, you'll want to be planning your cash flow from your highs and lows. So you don't want to be sitting with a lot of usage on your line of credit, for example, in a low part of the season. You want to have it available to kind of move it forward in a positive manner during those times. And then when your cash flow is high, you obviously pay that down from there. See a couple questions coming through maybe? No? Okay. So optimize for different customers. So your customers may have different expectations in terms of service levels and lead times. Weigh all these factors when you're setting inventory levels. And again, these are largely inventory based considerations. Consider technology. This is a big one that we're talking about largely with our customers, is that think about buying inventory management software, or just think about looking at software in general to manage cash flow, manage inventory, and manage the overall business. And then finally, dump losing products. And we talked a little bit about that before, is that if you notice that there's a product or service that's simply not working and not working for you, think about maybe removing it from your sort of product base. That may be a way of sort of taking control of the business from that standpoint. And that pretty much sums up sort of high level cash flow. I know that some of the topics like we talked about, like the last couple slides there as it related to inventory or whatnot, may or may not apply. But I'm hoping that we're able to pull some tidbits out of the rest of the presentation from that standpoint. So I'm gonna stop.
Yeah, so we didn't, unfortunately, I think everybody's like probably trying to read your slides and make sense of it all. So I'm sure everybody's going to go away and be like, oh man, I wish I would have asked that. But I have a question for you.
Yes.
So I know one of the biggest problems, and I'm sure, like I know Terry, I believe, is a new entrepreneur. I know Jillian, and I go to Jillian a couple times because I actually know Jillian and her husband. They're both entrepreneurs,
Sure.
you know, working from home, one staff. Jackie, as a realtor, it's just her. Marita, I know that she has, I believe her son is working for her right now, so she can make she can make sure she goes home and makes him dinner. I remember she told me that. But at a time like this, and I've always known that having your own business, you have to make sure that you're getting paid,
Yes.
right? You're not taking from your home account to put into your business account to put into your home account, you know,
Yeah.
the ever revolving door of credit cards, getting higher and things like that.
Mhm.
What do you think is your biggest kind of takeaway for entrepreneurs, new businesses, businesses that have been around for a while but have never kind of gone through this pandemic? Like, what would be if you can take one thing away from this presentation,
One thing.
one thing, what do you want these entrepreneurs, because a lot of the people, I'm looking at the phone call, and a lot of
Yeah.
them are owner operator entrepreneurs.
Sure. Um, I'll say this. So I think the one thing that I see on a daily basis, and I'll preface this from the standpoint of these are my clients. They're so they're not only my clients, but they're like prospects. They're people that I'm talking to, kind of, that have come to me and said, "Hey, I'm looking for money, or I'm looking to do this. What do you think?" Um, the biggest thing that I see all the time is lack of plan. Like, and I mean lack of any kind of monitoring of cash flow, lack of any kind of budgeting, lack of any type of like sort of foreseeing these issues coming up, and testing like what would happen, like what does this look like. um, I think you talked about one thing there where you said, like kind of reaching into your own pocket to fund um, some of the shortfalls and stuff like that. I think the unfortunate thing about that is that is sort of part of the cash flow cycle. That's part of kind of owning your own business, is that at some point in time you may or may not have to sort of reach into your pocket and put some money back in. But I'll preface that and say that you also have to have that exit strategy too. So it's one thing to put, $50,000 into your business, but how am I get like, as I put this in, how am I getting it back out?
Yeah.
Like, what do I have to do to extract that money back out? And many times, like I'll get financial statements and I'll be looking at them, and you'll see, shareholder loans line. And every year, it's, it was 50 grand, and then the next year end it's 100, and then it's 300, and then it's 500. And it's, what that's telling me is then I start looking at sales and I look at profitability as the next line items. And what does that story tell me? Well, if sales are stagnant and profitability is not there, all you're doing is funding losses, right? So then there's a conversation around, okay, how do we increase sales? How do we increase profitability? How do we increase margins in order to reverse that trend? Now, on the flip side, what you'll see sometimes is that that account is growing, but sales are growing, profitability is growing, and then you kind of look down at like maybe a dividend line item or a salaries line item. You say, okay, so what's that management salary? And that management salary has gone from 50 grand to 100 grand to 150 grand, and then dividends are being taken. Well, although they're putting money in, they have a strategy to get it out. And shareholder investment or shareholder loans are not necessarily a bad thing because we treat them as equity, so long as it's not funding losses. So to wrap up that whole thing, what I would say is this: track. Like, I'm a big believer, like track. Like, always be tracking and looking at, okay, what if? Like, before I make a personal purchase, if it's a larger purchase in my personal life, I'm looking at, okay, so this is what it looks like today in my budget. This is what it would look like if we cut an income out of our budget. And this is what it would look like if, there was a bit of a cash crunch and we needed to, fix a roof or something like that. Because you have to remember, like, your own personal life is just like a business. It's a living, breathing thing. So it's track. It will help you sleep at night, because you'll know exactly kind of where your cash flow is at. it sometimes can be scary off the start because all of a sudden you start tracking, you're like, oh my gosh, I didn't realize that, this was sort of the shape I was in. It can be positive or it can be negative, but it's a necessary thing to do. But yeah, if you are putting money in, like as you put it in the back of your mind, you should be thinking, okay, do I have a plan to get it out? And is that plan feasible as per my cash flow statement? And if it's not, what do I have to do to make it feasible? Do I have to, increase sales? Do I need to start pounding the pavement, picking the phone up to make some calls in order to go? And then quite frankly, there's market fluctuations that you can't foresee. So if you're in real estate, like right now, I mean, it's absolutely booming. Prices are through the roof. People are moving out of Toronto into rural areas, things like that. But it could have went the other way, where everybody said, "Whoa, I'm not spending any money," and that's something you can't. You would have to combat through personal funds.
Yeah.
Does that make sense?
That makes total sense. Definitely. Okay, so we just have a quick question. This will be the last question
Sure.
from Candace. Shouldn't GST, HST, and income tax be considered in your cash flow?
No, it's not your money. And this is one that, sorry, I shouldn't say it shouldn't be in your cash flow. It shouldn't be in your cash flow from the standpoint of using that money. That GST and HST, quite frankly, should go into almost like a trust account, and you should forget about it because it's not your money. All you're doing is collecting it for the government, and then you're remitting it. And in the event that, there's kickbacks and stuff like that, then okay, there's a kickback and it's recognized at the time of the kickback. So whether that's a year end or whatnot, like with the accountant comes back and says, your HST account or your GST account was at 20 grand and you were only required to remit 15 of it. Okay, well now that $5,000 of free cash flow is considered the business's, fine. Then you slide it into your cash flow at that point in time. But that right there is the biggest downfall that I see with small business is that I'll start going through the statements and you'll see GST or HST payable. And in relation to sales, it's extremely high. And you're like, okay, so what happened there? How come that is, 50 grand on $100,000 worth of sales? Well, I didn't remit it. So it's in arrears. So I'm paying I'm paying back arrears payments in order to take care of that. That's a full stop for a bank, because the interesting thing is when you think of like taxes or GST or HST, for example, those always come before mortgages. They come before any security a bank holds. So you buy a building, for example, and you own it for 5 years, and after a 5-year period, you've let it fall into arrears. And then let's say the company had to be liquidated because it wasn't going well or whatnot. That security item, when everybody comes to the table to say, okay, well, BDC has a mortgage on it, so we're going to take our $150,000 out of it or $200,000 out of it, the tax person, government or local municipal government will say, oh, hold on a second, there's $50,000 in back taxes owing. That comes out first and it compromises the position. That's why a bank always stops and says, you've got to clear that up before we can actually lend to you. And then what's your plan on the move forward to make sure that it doesn't go back into arrears? So should it be considered in your cash flow, i.e. a cash use item? No, because it's not your money. It's being collected for the government. So treat it as a trust account like a lawyer would, and stick it in that trust account and pay it accordingly.
Yeah. I think that's a great idea. I know my husband's family owned a restaurant, so every day the taxes were put into a separate account than the cash. Sometimes it was very hard not to dip into it, but they tried to do it as much as possible. Well, thank you so much. Thank you so much, Matt, for joining us today, and thank you everybody for I'd like to say getting up and getting out of your house, but probably most of you didn't, like myself, especially on this rainy day. It was kind of nice to do a Zoom call instead of having to go in and set up a breakfast. So hopefully though, Matt, maybe by the end of the day, you can get me some of the links for your site and checklists and things like that. I know Matt's always good about, having a coffee or a conversation if you need to kind of further this conversation with him. I'll also send you his email, because as we said, his portfolio is small business. So I think a lot of you would be great to have a conversation with him. And that is all. Thank you so much, everybody. And don't forget, we have 2 more events. Tomorrow is harmonizing your digital ecosystem. And then Friday is building your business model canvas with BACD. So hopefully we'll see you then. Thank you for coming.
Thanks, everyone.